Ever wonder how literally billions of dollars get managed in the world of private equity? It's not just about picking the next big company. It's actually governed by this incredibly detailed set of rules that decides who gets paid, when they get paid, and exactly how much. So let's pull back the curtain and really follow the money through the mechanics of a private equity fund.
Okay, think about it like this. Imagine you give a friend some cash to get their brilliant business idea off the ground. How do you make sure you get your original investment back before they start taking a profit? And what's your fair cut of the winnings? Well, private equity funds are solving that exact same problem, just, on a massive multi-million or even billion-dollar scale. And their solution is this really carefully designed system, kind of like a financial waterfall that we're about to break down.
All right, first things first. Before a fund can even think about buying a company, it has to get the money. And this isn't as simple as making a deposit at the bank. No, it's more like a two-step dance between the investors and the fund manager. It all kicks off with something called a capital commitment. This is basically a promise. An investor, who we'll call a limited partner or LP, legally commits to providing a certain amount, let's say $100 million, over the entire life of the fund. Now, here's the crucial part. No money has actually moved yet. It's just a promise, a legally binding IOU that's not even on the balance sheet. The cash only starts flowing when the fund manager, or the general partner, makes a capital call. They'll reach out and say, hey, we found a fantastic company to invest in. We need $10 million from your commitment, please. That's the moment the money is actually wired, and the accountants finally have something to put in the books.
And to keep track of all these massive flows of cash, every single one of those capital calls gets a unique lot number. Seriously, you can think of it like a serial number for a specific batch of money. It might seem like a tiny detail, but this is what makes it possible to accurately figure out who made what for everyone involved way down the line.
And now for the main event. How do the profits actually get shared? Well, it's all governed by a concept they call the distribution waterfall. I want you to picture actual water flowing down, filling up one bucket completely before it can spill over into the next one. That's exactly how the money flows in a private equity fund. So this waterfall has 4 distinct levels or buckets, and each one has to be totally full before a single drop moves to the next. Bucket number 1, return of capital. Before anybody even whispers the word profit, the investors, the LPs, get every single dollar they put in back. Then the water spills into bucket 2, the preferred return. The LPs get a minimum pre-agreed return on their money. Only after that's full do we get to bucket 3, the GP catch-up, where the fund manager finally gets a piece. And last, bucket 4, the carried interest split, where all the leftover profit is divided up. The whole thing is set up to protect the investor's money first. So what is this preferred return or hurdle? The industry standard is typically right around here, 8%. That means the fund has to generate at least an 8% return for its investors before the manager can even think about taking their share of the profits. You can think of it as the first performance test the fund has to pass.
And what's the big prize the managers are all working towards? It's this number, 20%. That's the famous carried interest, or carry, the manager's slice of the profits. But remember, they only get this after all the other buckets in the waterfall are completely full. It is the ultimate incentive to not just do okay, but to hit an absolute home run.
Okay, so we've got the steps of the waterfall down, but here's a major twist. There are actually 2 fundamentally different ways to set this thing up. And believe me, the choice between them dramatically changes who gets paid and especially when they get paid. On one hand, you have the American model. This one is deal by deal. So if a fund has one massive win, the manager can get their 20% carry on that single deal, even if the other investments in the fund are losing money. It definitely favors the manager because they can get paid much earlier. On the other hand, there's the European or whole fund model. Here, the manager sees 0 carry until the entire fund, all the deals combined, has paid back all the investors' capital plus their preferred return. It's a much more patient and, you could argue, a more LP-friendly approach. So this brings up a huge risk in the American model, right? What happens if a manager gets a massive paycheck from an early success, but then the rest of the fund completely tanks? Well, that's where something called a clawback comes in. It's basically a safety net that can force the manager to literally give back the bonus they earned to make sure the investors get what they were owed in the end. Let's walk through an example of that safer European model to see it in action. Let's say a fund sells a company and makes $100 million.
The very first $80 million goes straight back to the investors. That's their original capital. Then the next $6.4 million also goes to them. That's their 8% preferred return. It's only after the investors have gotten back over $86 million that the manager even starts to see a meaningful piece of the profit. The takeaway is crystal clear. The investors get their money back, and then some, before the manager gets their big payday.
So beyond that big profit split, there are a lot of other really important details buried in the fine print. These are the other ways managers make money and how some special investors can get a much better deal than everyone else.
You've probably heard the term 2 and 20 before. The 20 is that carried interest, the big performance bonus we've been talking about. The 2 is the management fee. This is usually around 2% of the total committed capital, and it's what pays for salaries, office rent, and just keeping the lights on. And here's the crucial difference. This management fee gets paid every single year, whether the fund is making a killing or losing millions.
And here's a clever bit of financial engineering for you. Fund managers can sometimes choose to waive part of their management fee, which is taxed at a high rate like regular income, and instead take that money in the form of carried interest. Because carry is taxed at the much lower capital gains rate, this simple switch can lead to a much lower tax bill for them. Now, in any given fund, not all investors are created equal. The really big ones, or the ones who get in on day one, often get to negotiate special terms in a secret document called a side letter. This is like their own private VIP pass. It can get them things like lower fees, the right to say no thanks to certain investments, or even something called a most favored nation clause. That's a guarantee that says if any other investor gets a better deal down the road, they automatically get that same sweet deal too.
So we've gone through capital calls, waterfalls, fees, and these secret side letters. But why? Why does this whole complex structure of rules even need to exist? Let's try and put all the pieces together.
So why have all this complexity? Well, it's because every single piece of this puzzle has a very specific job. The waterfall isn't just a payment plan. Its main purpose is to align the manager's interests with the investors. That choice between American and European models, it's not random. It's a calculated balancing act of risk and reward. And the fees and side letters? Those are the gears that keep the whole machine running and cater to its most important clients. It's a complete, interlocking system. So, what we have is this carefully negotiated system of checks and balances, and it's all built to protect the investor's money while pushing managers to get incredible results. But it does leave us with one huge final question. When you look at all the details, from the different waterfall models to the fees to the secret side letters, who does this whole complex system really favor in the end? The manager who's running the show or the investor who's putting up all the capital?